it's I think a good reminder that you can never be too certain. If you're investing in accounts that provide tax benefits, we can plan, we can do all the things, we can adjust, try to do everything as well as we can, but you never know because Congress ultimately holds the bag, and they can make the changes they want.
All thoughts and opinions shared in this recording belong to the participants. Views expressed are as of the recording date, are subject to change, and are not guarantees of future results. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Isaac.
Morning.
And John.
Morning.
And we are excited to be here. So
I don't know why my voice went up.
Several good topics to get into today. Anything you guys want to mention before we jump off? I've got the
football's back. I've been saying that for a while.
Football.
The preseason game was actually really good.
Hey, we like football, so
the Hall of Fame game was really
football is back.
Yeah.
I mean, like we're a month and a half away from the first game, but it's back.
It's back. It's been back.
It's been back.
Basically since the World Cup ended, it's back.
There was just one game, right?
The Hall of Fame game. Yeah. I think it starts full swing next week.
I still like my take on that. Should be called the future stars of the Arena Football League. But,
Right. Listen,
but that's not,
when the fourth string quarterback leads like an 80-yard game-winning drive, you can't help but be be pumped for the guy.
The Arena League starts calling. That's what happens.
They start calling.
Canada too. But that one kid did look good. Carson Beck.
Carson Beck looked good.
And he'll stay in the NFL.
Yeah.
He looked good.
Yeah. Okay.
Anyway.
I didn't watch it, but it is exciting that football's around.
Larry Fitzgerald in the Hall of Fame.
The only thing that's not exciting about football
cool.
being around the corner is the fact that we live in Arkansas and have to cheer for the Razorbacks. So,
yeah.
You know.
Hey, basketball season is right around the corner.
Right around the corner. It's on its way.
So, all right. Well, maybe we can overachieve.
That'd be awesome.
Okay, so.
Except for week 4.
What's week 4?
Tulsa's coming to town.
Okay.
Just
Are
watch
you going
out.
to show up in some blue and gold?
If Tulsa wins that game in Fayetteville, you won't hear the end of it for 10 years. So
but are you going to the game?
No, absolutely.
Oh, okay.
I may. We'll see.
All right. Anyways. Okay, so I want to start with this. So we had a question, comment come in a couple weeks ago from a listener. I thought it was good to just touch on this. So he asked basically kind of what is the sell in May and go away theory. He wasn't asking. I mean, he was aware of that, but we're going to kind of clarify what that is. And then just maybe why that hasn't proven to be true as of late relative to history. Mm-hmm. So sell in May and go away is basically, there's different iterations of it. Different people have different takes. Kind of the most broadly accepted and understood sell in May and go away is basically like, hey, sell stocks in May and buy again in November.
Yeah.
Because the best rolling 6-month period in the market is November to April. Right.
Mm-hmm.
And the kind of the May to November has historically lagged. So, there's all kinds of, there's all kinds of like trading and investment philosophies and different strategies, right? You have some of them are seasonal, some of them, this one just happens to be, it's the basic idea of like, well, what are the best performing months and what are the worst performing months? And get out of the market historically in the worst performing months and stay in it in the best. And for a long time, the numbers made that look appealing if it was that simple. But as of late, that hasn't held up to be as true. The market's done pretty well and had some really good summer rallies. So what are your thoughts on this, John? And
I did a little research on it because it's an interesting topic.
Yeah.
Since 1945, November to April has averaged 7% gains, while May to October has averaged 2% gains. Mm-hmm. So that is pretty dramatic. I didn't expect that to be the actual that big of a spread, which kind of gives stamps what they're saying. But not only that, it goes back. They've looked at this study for over 37 countries. And they've observed this historically since the 17th century in the UK, and it is a phenomenon that has been the case going back to the 17th century. I guess people go out and do things in the summer.
From what I read was the traders go on vacation.
Yeah. I mean, it's just I don't know how else to explain it. If you go back that long. Now, granted, like it doesn't mean it's always going to happen or whatever, but that's just an interesting
and it
stuff I read there.
Recently, I mean, since I've been alive, it's just so much easier to work from anywhere. Like, you don't have to be on Wall Street to do your job anymore. And so I think that's probably a lot of the reason that it isn't as relevant anymore. Is like, these guys can be on the beach with their feet in the sand and get a notification on their phone and be like, oh, shoot.
Exactly.
So like John said, historically, 2.1% May through October. But over the last 12 years, the average return has been 5.1, respectively, with positive outcomes in 82% of cases. So you have to just ask yourself, right, if the last 12 years averaged 5% from May to October through October, or even if it was 2%, what's better? If you're up 82% of the time, the average is 2%, or set in cash.
Yeah, exactly.
You know, like
exactly.
So, yeah, I don't know the exact reasoning for why it's gotten better. I think
Isaac's point is really good.
Yeah, just that people invest and have access to investing and the way they run their businesses and
through your cell phones.
Yeah.
I mean, you can.
Yeah, it's just different than it used to be.
Yep.
So maybe that's taken some of the seasonality out of it. But
it's a good question, though. It kind of made me go back and look, and it's interesting to see the data. It is kind of cool.
Yeah.
But I think the last 10 years we've not talked about it because it hasn't been as prevalent.
Yeah. All right, moving on. So drawdowns and household names. So this chart, I'm going to throw it up on the screen. 52-week drawdowns in household names relative to what the S&P 500 has done. So you can see this: Oracle, Coin, Nike, Robinhood, Netflix, Palantir, Tesla, Adobe, Salesforce, Uber, all down almost, other than Uber, 30% or more from 52-week highs, with the S&P sitting right there at the 52-week high, or just under, and this is as of yesterday. So I think the big takeaway here is just like the market is an unbelievable thing, right? I mean, if you said, now I know some of these names, I mean, you've got Oracle and Netflix and Palantir and Tesla, so even in Salesforce, you got some big companies in here. But, if you would have said, and a lot of people did say, hey, if some of these big names, NVIDIA, Oracle, Netflix, Tesla, sell off, right, they're going to bring the market down with it. Too concentrated, right? Too few names are driving most of the market returns. That's kind of what we heard and what was easy to believe over the last few years. And we've seen a lot of volatility and some major drawdowns in some of these names, and the market has continued to hit all-time highs.
Yeah, which I love. So I'll give, like, institutional investor ETFs, mutual funds, money managers. I was reading the article about deeper dive into this little thing, and it made sense when I read kind of what some of the reasoning might be. These stocks, soared and led the market, as you said, basically since 2020 through now. Well, if you think about the big institutional investors, there's a point where they can get overweighted too much in these stocks. Mm-hmm. What I love about the healthiness of the market, I've been a little bit nervous about this market, but the healthiness of the market is kind of proven when they sell those shares to kind of limit their exposure to one stock, and then they buy other shares of other stocks, right? Which has kept the market where it's at. It's not like the money's coming out of those shares and going to cash. Yeah. It's not fear selling from that company per se. To me, it's a lot of institutional investing, just rebalancing from these.
It's not risk off. It's just
reshuffling.
Yeah.
And I think that's a healthy sign of the market, because you're right. If you'd have told me that these names a year, go back a year and said that, I would have been like, oh yeah, the market's
probably down 10-15%.
Yeah. But I like the idea that this money is not flowing into cash or gold or CDs. It's going back into the market.
Yeah.
How much do we not give the market credit for? Just think of, John, you were in your prime in like the 70s. So no, I'm just kidding. No, but think of like 80s, 90s, early 2000s. The average investor was so much less educated than they are today, right? Just because of how easy it is to get information. Mm-hmm. Some might say there's some negatives to that, which I could make a few points down that path. But overall, generally, it's a very positive thing, right? And so people understanding that, hey, there's volatility in the markets, that's fine. It's more about your time horizon. Yeah. We're not trying to buy and sell and time things perfectly all the time. Like, as a core part of my portfolio, I should generally capture what the market's doing. and just let it do
Yep.
its thing. Right? People understand that and are comfortable with that and get that way more today than they did 20 or 30 years
Yeah.
ago. Right? And I think that starts to impact the market over time.
I agree.
Right? Because you don't
Yeah.
get the same knee-jerk reactions, the same fear-based selling at the right time. Now, I'm not going to say, I'm not saying that doesn't still happen and won't happen and can't happen, but just not to the same degree. I think people are generally more educated around risk and what that means, and so they're more comfortable taking it.
Yes, I also think the money flow into the market is
It's incredible.
is getting much more, and it's not just from the lack of fear or whatever. It's 401ks and so on. Like you go back to the 80s and 90s, and that was not as you might have
the
25%.
401k just started in the early 80s.
Yeah.
Right. And so, I mean, how long did it take before
that took off.
that became actually like where it's like, hey, a majority of companies offer a
Right.
401k and most people are actually contributing. And like now we're having conversations around the Trump administration's, looking at, hey, do we implement something like Australia where the employee or the employer is forced to contribute a certain amount? And so it's like that flow, that new money into the market is a significant
It's
thing.
massive. I think that's massive. I also like the technology that we have now. It's like a casino. Back when I started, a lot of people would look at the market like a casino. Oh, I'm just gambling my money. I mean, I'm just, throwing dice, which obviously that's not true. And the more information you have, the more you learn, you realize that's not true. Companies. Last thing I'll say, Isaac, honey, you need to get the floor.
No, you're good.
When the Dow hit 6,400, I know we talked about the Dow, in March of 2009, and now it's at 54,000. There were a lot of phone calls that I made to people to get them into the market, out of cash, whatever. And the overwhelming attitude was, "Oh my God, the stock market's going to zero. America's done." That was a very common theme in 2009 after what we went through, which is after I was talking about this the other day. After I was listening to that repetitive from clients, I realized, wow, emotion is the biggest killer of success in the market, because I knew the market was not going to zero. I knew the American economy was resilient. I knew we were the best country in the world. I didn't think we'd go from 6,400 to 54,000 on the Dow in this short amount of time. But the point is, the market is resilient. We have to take the emotion out. Technology, information, everything we have in front of us is just so much better now than it had been ever, which gives people more advantageous to go in, and then we have more opportunities to go in through 401ks.
Yeah.
Blah, stop. I'm done.
Good.
All right.
It's good stuff.
John needs a water. Any
No,
thoughts?
I mean it's actually interesting, like what you kind of said, where the kind of average investor is just more educated, and they're almost. You see these drawdown days in the market, and normally that would turn into like a longer extended downturn, and then the second there's even like a glimmer of positive news, it just rips back, and it's like people are begging for a reason to buy or put more money in. And I do think that comes down. I know institutional investors make up the majority of the market, but I think individual sentiment matters a little bit in those decisions.
It does, and corporate profits obviously matter.
Sure.
And so we've been ripping and roaring on that. As long as that stays the way it is, and everybody has access like they have feasibly.
And there's just
going
been
for a
so
long
much
time.
volatility. Like I was just looking at, how many times have some of the Mag 7 names, so just most popular names, biggest names in the market, how many times have they dropped 50% or more, over the last handful of years? Tesla 4 times, Nvidia twice. Meta was down 74% in 2022. 74%, right?
And that's
Sounds
all,
like a
that's
buying
all
opportunity.
anybody wanted to own for the past. Like, how many conversations have you had with people like, why do we not own this or more of this?
Yeah, and
for the
so I
past
think
couple
people
years?
have just gotten more, not that we like it, or that, but just more comfortable. They're like, this is just part of it. Like this is just going to happen.
Mag 7 year to date, 5%. S&P 493, 12%.
Yeah, so
Pretty cool.
very cool.
It's good. That's a total flip. I love it.
Yeah, so I think it's awesome. I think it says a lot about the average investor, and all the kind of mechanics behind things like we were talking about.
My
flows and-
evil dark side is going to come out.
Yeah, go for it.
And say that you could throw a dart for the last 15 years and make money. You could throw a dart at a dartboard and hit any stock and kind of make money. It's been so simple and easy.
Kinda. You wouldn't have. There are long stretches where you wouldn't have made much money.
No, I know. No, I'm just saying, like, just in general terms, the
Yeah.
market has just roared, and if you're part of it at all, you've excelled, and it has become easy. I have met a lot of younger clients that they have been investing for themselves. I'm talking about 40 and under. Their whole life they've been investing for themselves, but because their whole life of investing started after 2009, it has been just easy.
Yeah.
Life is easy. There's never going to be, and I temper that a little bit in the sense that there will be a testing moment for people in their lifetime, and can they emotionally ride through that and still, participate in the market?
I'm looking at the top 10.
Isaac's trying to count to
Sorry.
10 over here.
Sorry.
Yeah, see what
I'm up to 3. I'm looking at the top 10 companies in the S&P by size. In 2015 compared to 2025, there are only 3 that are the same. Just how things shift.
Yeah. Yeah. Crazy. Go back to 1995 and you'll see.
Yeah. Oh, yeah. I mean,
bunch of them gone.
85 is not Exxon? No, there's not one.
Yeah.
So it's Apple, Microsoft, and JP Morgan.
Well, if you look at the last 10 years, so I pulled up some of the AI kind of big names. I've got NVIDIA, Micron, Microsoft, Netflix, not so much AI name, but Meta, Broadcom, Apple, and AMD. You look at the last 10 years, I mean, the average annualized rate of return on these names are incredible.
Yeah.
Right? I mean, and you've got NVIDIA compounding at over 100% a year, Micron 80%, Microsoft 35%, Netflix 84%, Meta 18%, Broadcom 10%, Apple 40%, AMD 70%. That's over the last 10 years, right?
So do you think that can continue in the next 10? And I'm going to pick on Netflix.
No.
Yeah,
No,
can
I mean, they
Netflix
can't.
continue to do that?
But this is
crazy.
Not forever.
Yeah, not
You
forever.
can't
Yeah.
compound at 70, 80% a
Yeah,
year
yeah.
forever. But what the counter to that, not the counter to what you said, but just the good thing to remind you is but that doesn't mean it's not a good company that continues.
Oh, yeah.
That continues to grow.
Yeah.
It's just maybe it grows.
Don't get used to it doubling.
5 to 10% a year, right? And
Yeah.
and that's normal with a lot of these names, right? And there'll still be cycles where then it doesn't do anything. Instead of compounding at 80% a year, it may go through a 3, 4, 5 year stretch. It doesn't do a whole lot, and then you see a rally. And
Look at Walmart. I mean, if you go back to the history of Walmart, my goodness, the growth through the 90s, from the 70s, 80s, and 90s, and then it had a stall for 10 years. It stalled. And then, of course, it's been growing ever since, right? It's been massively growing. But to your point, it doesn't mean it's going to continue to grow, but it's still great companies.
Yeah.
So,
okay. Energy share of consumer spending. I thought this chart was really insightful. So, there's been so much volatility in oil and gas prices as of late. We got, I don't know what the high was a month or two
over
ago.
100. You mean you can talk about?
Well, oil over 100, but gas
Prices,
national average got up really high. They've come back down, but it just hadn't seemed to really affect too much. I'm sure there are specific businesses and specific parts of the market that maybe started to feel it, but across the board, it just didn't feel like it shook anybody up too much. Is that fair?
A lot of social media posts.
A lot of social media.
That was about it.
Oh, I mean, it pissed everybody off, but
Yeah.
in terms of the numbers or the market. Just haven't seen too much of a reaction.
As long as that word transitory is in effect, like in other words, it spiked and then it comes right back down, we're fine.
Yeah.
My concern if it lagged on for a lot longer, then you would start seeing price of goods going up because the price of goods would be all of these companies need to transport stuff, and so they would be passing that on to the consumer.
Right.
That would be the one thing they take out of this.
Yeah, I think that would have a bigger impact on the consumer than
just the actual
spending
out of
the
your
consumer,
pocket.
because this chart illustrates that. Going back to 1970, this is the energy share of consumer spending. It shows how steadily it has come down. Right. At a peak, it was 9+% in the early 80s of average consumer spending. That's what people were spending on energy.
I owned a moped then; it wasn't really that expensive.
Yeah. Yeah. Okay. I can see you owning a moped. Take that however you want. And today it's down below 4%, right? So that's been a steady decline. And so like you said, John, the longer oil stays high and gas prices stay high, and the higher they go, that will start to have an impact 100%.
Could, yeah.
But
Should, or would.
it probably wouldn't, and it shouldn't be the same as it would be back in the 80s.
Right.
When people were, gas prices go up 50%. You're spending 10% of your
right.
income. I mean, that's a big deal.
That's a big deal.
So I think we're just a little bit more, have a little bit more kind of protection from that and the volatility in energy prices as consumers, which is good.
And I think that's energy independence in the U.S. is a massive part of that chart. We started that massive energy, when it kind of we had that massive problem in the 70s and 80s, and then it started getting better. I see all kinds of little newsflash stories about how we're running out of oil. Have you seen that? Or reserves in the U.S. and so on?
Yeah.
I don't buy into that too much. I think the pumps are still going full steam, and I think we're fine.
Well, if you look at, I wasn't going to pull this chart up, but let me throw it up here. This is, don't get mad at me because I'm not saying people will be like, well, that's not fair. But gas prices look different when you adjust for inflation. So if you look at gas adjusted for inflation, right?
Right.
I mean, it's kind of incredible how cheap gas has stayed.
Yeah.
Right.
Gosh, yeah.
So, you see the average price of gasoline, $3.93. When you adjust it for inflation, going back to the 1990, it's $1.81.
Go back to 1980 and find out how much it cost to go to the U of A for 4 years and how much it costs now to go to U of A to like a complete opposite of oil and inflation.
Yeah, so it is kind of incredible how cheap
that's
gas
cheap.
has stayed
over
the years.
I agree with that.
Last thing, proposed changes to tax shelters accounts for the wealthy. So this is just kind of a punch in the gut for you, and a little reminder that Congress can just do whatever they want.
Yeah,
and so this is proposed changes. Hopefully it stays as proposed and not actual changes, but proposed changes that a couple of Democrats put out, I think just yesterday, introduced a bill that would prevent the highest earners from abusing tax-preferred retirement accounts such as IRAs and 401ks as tax shelters, even though that's what they're designed to do.
For.
Yeah. The proposal targets individuals with modified adjusted gross incomes of more than $400,000 and would cap contributions to traditional or Roth retirement accounts if they have more than $10 million in tax-sheltered accounts. Okay, that stinks. Doesn't sound too bad. Then you get down here to the bottom. What the proposal says. So, under the proposed legislation, contributions to tax-favored retirement accounts will be capped for individuals with more than $10 million in these accounts and with more than $400,000 in modified adjusted gross income. Those with elevated MAGIs, modified adjusted gross incomes, will have to make minimum distributions, the legislator said. Individuals would have to withdraw 50% of any balance over an aggregate $10 million between their traditional, Roth, and defined contribution plans. Those with aggregate balances of more than $20 million could have to distribute as much as the entire excess balance from their Roth. So they're talking about, okay, let's say you have $12 million. The way this reads is you would have to draw 50%.
So you take out $1 million
of any amount over 10 million, so you're going to be so it's almost like the required minimum distribution, but it's based on a dollar threshold and how much you're over that, not a life expectancy calculation.
There's always something in there that just makes me feel like you put that in the bill to just make sure it doesn't pass.
So
my least favorite thing before you go on a 10-minute rant.
Yeah,
my least favorite.
It'll only be 5 minutes.
My least favorite thing. Well, this one may deserve a 10-minute rant.
I'm telling you
about this kind of legislation is it's a slippery slope. Like when this, it's if this ever got introduced, it did get introduced, but if it ever got passed, it's much easier then to adjust the thresholds, right? Then because it's not this new idea, right? So. You introduce this and it's like, okay, it doesn't affect that many people, blah, blah, blah. All of a sudden they say, hey, we're going to drop that 10 million threshold to 5 million. It's like, okay, and it just gets easier and easier for them to make changes from there once they introduce something new like this. And I hate that. And it's, I think, a good reminder that you can never be too certain. If you're investing in accounts that provide tax benefits, we can plan, we can do all the things, we can adjust, try to do everything as well as we can. But you never know because Congress ultimately holds the bag, and they can make the changes they want
anytime they want.
Anytime.
And here's my rant. You ready? These drunk sailor idiots in Washington, and I'm talking both parties, so let's be clear. I'm not picking on one party. These idiots have run this country into the ground, spending on the dumbest of things for the longest of times, and nobody's called them on it, and nobody cares, and all they care about is getting reelected. When I see stuff like this, it makes my blood boil. These guys have insider trading things they've done forever and never paid a price. They've done all these bad things and never paid a price, but yet they have the audacity to come after people that have worked their tails off. What they don't understand is all these people that build up this wealth, it's not an evil thing. These, for the most part, yeah, there's, I'm sure, evil people out there, but for the most part, these are the people that give jobs to other people that create this incredible capitalist society that we have where you have an opportunity that no other country. I've lived in Europe. I've been to Turkey. I've been other places. This is the best system ever, but we are screwing it up day by day with our idiots in Congress. And I'm telling you, the very first person that ever says they will run on term limits, I'm voting for that person. I don't care if they're Democrat, liberal, conservative, Republican. If they say they're going to run on term limits and force term limits to be put on this country, on Congress, I'm in.
Well,
Sign me up.
What's scary is the debt situation, the lack of control when it comes to spending, and then the immediate the proposals are always around how do we increase revenue, especially from the Democrats, but neither party is serious about getting spending under control. And this is a proposal when Republicans have control. Can you imagine? If Democrats control,
which they're
everything, which
probably
could very well happen at some point.
Well happen.
And what kind of changes will they put out there then? So yeah, it is. I think it's just a good reminder to not have all your eggs in one basket, right? Both from a stock perspective that we just looked at, names can sell off and be down quickly, but also from an account, don't have all of your money in 401ks, Roth IRAs, have some of it just in investment accounts. There are ways, we have technology now, there are ways to manage the taxes in an account, even if it's not an IRA and Roth IRA, to limit that, right? And so just know that, there's some, I've heard a lot of advisors say, if you have a 401k, it's a jointly owned account. It's you and the IRS or you and the government, right? And these kinds of headlines are kind of a subtle reminder of like, okay, there's actually some truth to that.
Yeah.
I do think it is a massive thing for us as planners. And we always talk about buckets of money when you're building up a retirement. And young people especially, I think it's so important to use the IRAs, like 401ks, always get the match from the company, right? At least put enough in to get the match. Use Roth if you can. You don't get the tax break, but if you can do the Roth and get used to that, so smart. But also have a taxable account that you invest to that's not tied to IRA.
Yeah.
So 3 buckets. I mean, Roth, traditional, and a taxable, and then spread that out to your point. And then you're okay when some of these kind of crazy things
flexibility
happen.
to move when things like this come up.
Yeah.
Sure.
Yeah.
For sure. All right. Anything else?
Oh, I could go on for another 20 minutes if you want me to.
We're going to turn the cameras off and let John talk.
If you want to know more about how the government can screw things up, see California and how they can extend their overreach on you for taxes. Drives me crazy. Now I'm in a great mood.
Yeah. No. Any other takeaways? Anything else we want to talk about before we jump off?
I think that's all of it.
Any hot takes? Claire had on her notes section that we need a hot take.
Ooh,
a hot take.
Yeah. I don't have one though.
Well, it's hot outside. It's going to be like 99 degrees for the next
forever
10 days. Is that a hot take? Is that considered a hot take?
I saw a headline today, hottest month in 120 years.
Is August?
It was either August or July. I didn't read the actual article. I saw a headline.
Probably July. I'm going to guess.
Yeah.
That's hot.
Yeah. It's probably
So that's a hot take. I mean, that's a hot take.
I'll bring one. I'll bring one next week.
Yeah, I'll bring one next week.
All right.
Claire, I promise. I'll have a hot take next week.
All right.
You'll be blown away.
We can't wait. All right. Well, I appreciate you guys. Thank you for watching and listening. Send us some questions. Shoot us an email. Leave us a comment. We appreciate you guys, and we will see you next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.